This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today we're here with Shruti Gandhi of Array Ventures. Shruti, thank you for joining us.
Thanks for having me.
Can you tell us how you got into early stage investing?
Oh, long story short, I had a company and I could have done all things differently there, but I wanted to figure out how others do it. So I started dabbling a little bit into venture, started working at a few funds and helping them out. And that's when I realized that I actually love it. I started seeing some early exits in companies, some funds I was working at Light Bank in Chicago as an intern, High Bar in Bay Area. They started seeing exits of the deals I had been helping them with. And I said, maybe there's something here that I should learn more about. That's the beginning of my journey. I started working at Samsung in the corporate venture arm. And again, I started seeing some exits there. Some of my companies I was on the board of, like Apple, McGraw-Hill, Samsung, ended up acquiring some of these companies I was on the boards of. So I just started loving it. And I thought the experience of working with founders, helping them solve a problem, and then to see them succeed by being acquired or whatever the journey that might end up happening was pretty fruitful. So I continued to do that. I ended up joining a institutional fund after that called True Ventures. And then about 3 years ago, started my fund Array, with the idea of founders need help at the earlier stages. And if you help them get to a proper revenue, and if you help them fundraise, and if you help them see how they should go to market in the most efficient way, then, you are well suited to be an early stage investor. And I love doing all that. I love to help my founders be almost like one of their co-founders. That's the core reason why Array was formed. Some of my old founders basically said, you were really awesome and we want to back you and be part of the fund. And that's how Array started. And that's what we focus on.
So what startups fit best your investment model? What do you look for? What's the criteria for the startups you bring in?
We invest early stage in an enterprise, data-driven, deep tech companies focused on AI, ML, robotics, security. Those are background and expertise. And we think that founders at the early stages may have the technical background, but they don't have a more context on how to go to market, grow their revenue fast. And so that's the kinds of things we focus. We relate with the founders and we understand the kinds of problems they're trying to solve, and we help them grow by providing them thoughts on customer development. We do workshops on helping them think through positioning, go to market, marketing. So that's where we try to stay unique. And that's what we focus on at Array.
So for those who go through your program, what you help them a lot with the go-to-market positioning and so forth. What else do you do for them as far as help them get on the right growth path or get in the right direction?
The growth path is simple. When we invest in them, the companies usually were the first institutional check. So we invest with the angels and the same round. The rounds are 500K to $1 million. And the companies are usually pre-revenue. And then when we invest in them, we have a clear visibility on how we think we can get them to $1 million in ARR. We can see how they get to that point. And then after that, if we invest in the later stages, or if we're helping our companies at the later stages, we truly put energies into marketing and sales, and how every company has to take a different approach towards that. And that is why the workshops and the programming we do is around getting the companies from 1 to 10 million ARR and in a reasonable amount of time frame.
So you invest in pre-revenue companies and you're taking them from $0 to $1 million, and then in maybe a second stage, you're taking them from $1 million to 10. Is that correct?
Yeah, we help them think through that. Exactly. The resources needed for them to think through that, get the coaching around that, get education and training around that is what we focus on.
So are you looking for companies that have already figured out product market fit at a pre-revenue level, or is that mainly what you end up doing in the $0 to $1 million is really establishing a very solid product market, channel fit, founder fit, all those things and how that works?
At the stage we invest, founders are usually passionate and they have the technical background. And then oftentimes we love investing in ancient industries that need reviving. So we look for an expertise in the founding team on that industry. So for example, I have a company called Mapistry that is in the stormwater compliance space. And one of the founders is a ML expert, PhD dropout from Berkeley. And another co-founder actually understands all the requirements around stormwater compliance and works with the government on writing some of these sometimes. So that's a good ideal team for someone we would love to back. It's a technical savvy and has very good in-depth knowledge of the industry. If we had to pick and look at one more dimension around it, we also love in the founding team a sales expert, not necessarily someone who's just purely done sales, but like the mindset of and a personality of wanting to sell. So that's usually a third dimension we look for in our founders, where we think that those three skills kind of make it a really good founding team.
Well, that's great. Domain knowledge is always a key factor that seems to be missing from most startups. I find in healthcare and fintech and other sectors, people have developed a piece of code. It works great, but then it comes time to sell it. Nobody knows much about the healthcare market or the banking market or what have you. So the domain knowledge seems like is a key element. What if they don't have that? How do you fill that gap?
Sometimes in newer industries, like a blockchain, right, we talked about, everyone has the same amount of knowledge. It's then at that point, it's about their willingness to learn, how much they've involved themselves. I mean, we don't look for expertise just from a degree kind of a perspective. We look at it from a holistic perspective. So depending on the industry, we decide to make our decisions at the time accordingly.
So what do you think about blockchain and some of those technologies coming up? It seems like you're in a lot of the cutting edge technologies like AI, robotics, and data analytics. Where do you guys land on the blockchain?
We also invest in the blockchain world. So out of the last 4 investments, 3 were in the blockchain world. One of the company called Merkle Data is kind of like a Google Analytics, Bloomberg for data. So understanding the movement of money in the crypto world. Another company I've invested in is a company called Stockhold. And that company actually is kind of like a Schwab exchange for private investors, right, for in the crypto world. And then we have another Texas-based company, actually, a company called Series X. And they help link between trust and background checks through the blockchain world.
Well, that's great. That's great. Well, I noticed you look for platforms that change the way an industry works. And it looks like you're going after maybe new industries that haven't been touched a lot by technology. Is that right?
I would say we go after old industries that haven't been touched by technology. Exactly. So bringing like a packaging industry or a supply chain industry or an agriculture industry to the 21st century is something we love doing. And so when we think of deep tech, we try to see how we can apply AI, ML, robotics, etc., to those industries to help them make more efficient and productive and generate more revenue based on all the innovation that they are willing to adopt.
And so what do you think are the top industries you think are open at this point for this type of disruption?
Yeah, as I mentioned, supply chain, agriculture, health. Basically, there's room in every industry to be able to make a difference. Automotive, we have investments in the autonomous driving category. So fintech, obviously, with the blockchain, crypto world. So we are industry agnostic as long as we think that either it's not a crowded space, or if it is, we know why this company needs to be backed over every other company that exists in the category.
Do you look for industries that are heavily regulated like healthcare, fintech, or do you shy away from the regulatory given the challenges that come with it?
We invest in those industries, except we don't invest in biotech and consumer. We don't invest in those categories because, one, we think those categories require a lot more capital and longer horizon. So we try to invest in categories where we think that you can start seeing results early on.
Do you look for applications that are true platforms? You have the entire value chain stack, or do you not require such a broad definition in order to pursue an investment?
That's actually a great investment for us if the founder has the vision to go after the entire. We like investing in companies that are trying to address the entire value chain, but as you mentioned, it takes a lot of capital. So what we tell our founders is to go after one piece, which can enable the other pieces as we start making progress. But it's about the vision at this stage. They're not going to be able to solve everything right away. And so we will make an investment based on the large vision as long as that is what they want to go after. But initially, they're targeting a smaller piece of that pie.
And so we touched on the team and the importance, and then we've touched on disruption and the value chain that come in the platform that comes with the value chain and so forth. What are the other key areas that you look for or criteria you look for in a deal to see if you want to invest in or not?
We like team is the most important thing. And then there is areas which we talked about, which is what are you really solving? If you're like another Me Too company in the marketing automation, sales automation space, we are more critical. But if it's a new industry where there are no existing players, we try to be a little bit more open minded with where the company can go. So it depends. Outside of that, outside of the team and the areas, the round size has to really match up. We don't want founders to raise too little or too more. So ideally, they don't have a initial traction or so forth. We try to see if the founders should raise like a $500,000 round to kind of get their bearings, and then raise another couple $1,000,000 after that if they really can understand or see where the product market fit has come to, or if they really need an additional capital or not. So it's a different stage approach. I think stage is a very valuable thing for a lot of VCs. And for us, we love investing in the pre-Series A rounds.
Well, in the last few minutes we have in our interview today, what else should we cover that we haven't so far?
I think cool thing for founders to understand is how VCs work, how they get their capital, and how funds are raised. And I think we can cover a little bit of that for founders to really get a sense of both sides of the table here.
So what do you wish a founder knew about the fundraising process that you find most people don't?
I think founders sometimes forget that VCs actually have to fundraise as well. And they have to raise capital from other investors. And then they have to have certain type of returns for the funds they're trying to raise. And usually every fund has a different kind of mandate and numbers that they're targeting. But founders kind of have to understand that game to then see what kind of company they're pitching to what kind of investor and if there's a fit on that perspective. So I think that we can go a little bit more into that if you want, but I think that's the biggest thing founders forget to focus on a little bit.
Why don't you describe a little bit more about how a founder should determine that, or in order to appreciate that? Because I agree, most founders don't think about it. They're just looking for funding and they're knocking on every door. But maybe they should think about which doors they knock on and if it's a good fit.
Yeah, I think founders should be more diligent around understanding a VC's fund size and the kinds of tickets they need to write to make their numbers work. Usually, on an average side, a VC is trying to have a return target that they're going for. And so if the fund is $1 billion, they're trying to invest a certain amount of capital in every company. And there's only so many partners in the firm. And so you have to understand that if that's what the case is, they're going to have to write larger checks. And if you're not raising that much capital, or if you're not ready for that kind of raise, then wasting your time on those kinds of funds can be bad for you, basically. So, or you have to understand if they have a seed program that they should know about, and how do they treat the companies that get seed capital from those kinds of funds. So it's a lot of questions that founders can actually ask the investors to get a better sense of fit as well. Because founders, yeah, you're right, are knocking on every door, and then any check they get, becomes really valuable at the time. But then if your composition of the round is not right, oftentimes founders are left helpless, especially when they then try to raise a follow-on round and things as such. And founders were really not thinking about it at that time when they're raising the initial round.
Well, it seems like a lot of that data is available out there. It just seems like founders could make use of that data before they knock on the door. Or do you think that's a possibility? Do you think that's readily available to them?
Yeah, I think if they look up Crunchbase or just read a little bit more, they'll get a sense of the fund dynamic, the last checks that the fund has written, where in the fund cycle are they? And then it's also about the relationships. Like, do you get along with this partner? Do you get along? Does the partner have the incentive to help you and see you succeed? And that's a very important thing people miss as well, right? Like they kind of forget as they're putting together these rounds, as founders are putting together these rounds, they forget it's a long-term game and they're just focused on the current round and not in the long-term relationship building. So yeah, every founder has to optimize for all of this at every stage. And fundraising is not a one-time game. And I would take money any day from an investor who really believes in you and sees things in you and wants to spend time with you, versus someone who wants to just give a check and disappear. So that's just my personal kind of bias. But founders have to think through what they're optimizing for.
Well, that's great. So appreciate your taking time. How best for the audience to get back in touch with you?
They can find me on Twitter. I'm at Shruti. And then, feel free to reach out to me on LinkedIn.
Well, great. We'll put those in the show notes and let people, as well as the website, so people can get back in touch with you. Thank you so much for taking time to join today and hope to have you back in the future to dive deeper into some of these topics.
Absolutely. Thanks so much for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.